What's up, everybody? My name is Sebastian. I'm going to be showing you guys through the investment summary tab in the Excel model. And obviously, you guys have gotten familiar with the model up until this point, and now it's time to show the returns because we are, in the end, showing um, to investors. We are pitching, and anywhere you go, really, it definitely will come in handy to have an investment summary tab as you're pitching to investment committees or whatever it may be. So starting off, we've got our total equity check, and that's just a sum function of our LP equity and our GP equity. And kind of what I'll be doing through this video is going over high level what the formulas are, how we got it, and then how we like to show it on this investment summary tab. Moving on, we've got our stabilized yield on cost, and that's just our NOI over total costs. So as you can see here, it's a function from our pro forma that's really just taking the sum of our cash flows and then dividing it by J23, which is on this tab. As you can see, that is the total cost for the project for the whole property. Our project level IRR is from our waterfall. As you can see here, C29, you scroll down, project level lever net IRR. Same thing, I mean, with our compound annual value growth, it's a rate function. So we're taking our hold period of 5 years. We're having no payments through that period. Our present value is a negative of J19, which is again our purchase price. And then pro forma BK54 is our exit, our projected exit, what we like to sell for. And then we have no payouts through that period. Moving on, we've got our LP IRR, which is just from our waterfall again. Our LP average cash on cash is an average of these operations cash on cash percentages. And then our LP equity multiple. This is a function so this round means you're rounding it to a certain number, and then you're taking the sum of the waterfall, which is the distributions over the contribution of the LP sponsor. So as you can see here, it's taking it's taking these distribution values and then dividing it by the contribution to get the LP equity multiple. And then this function is saying we want it rounded to 2 decimal places, and then we want it also to have an X after it to demonstrate that it's a multiple. Our minimum investment size, this can change obviously model to model, but for this one, it's $100,000. And then we've got our operations cash on cash, which is a sum of our waterfall, again, our net cash flows over our initial equity. So it's pretty much the same thing that you saw there, except we're not having it as a multiple, we're having it as our cash on cash. And these numbers are obviously going to be the same until you reach sale, which will then take into account the distribution for the sale. And then our total cash return is taking so E6, it's taking our operations cash on cash, you're multiplying that times F3, which is our minimum investment size, and then you're adding your sale cash on cash times, again, the minimum investment size of F3, and that gives you your total cash return for year 1, year 2, year 3, year 5, and then your total. Now, moving on to project summary, we've got, for this project, we're estimating 3-year stabilization. Now, this is hard-coded, but obviously this is in inputs. It's our lease-up timeline, 36 months, and then it's also over here, lease-up timeline, 3 years. And then our hold period we're saying is 5 years. CapEx and reserves. Now this is a sum of these two, and then for interior, exterior, 3, and reserves. So for interior, it's from inputs and assumptions. You're really just taking your units and the inputs assumptions, your units, and then multiplying it times your CapEx, your renovation costs per unit, and then that gives you your total. And then for this specific project, we're assuming that we're just going to split it in half, exterior and interior, for the CapEx expenditures. And then our target sale price is from our pro forma. That's just from our sale date. That's our net proceeds, sale proceeds, and then per unit, again, we just divide that by um, 0.12, which is our number of units, and then per square foot, we divide that by 0.11, which is our net rentable square footage. Now, annual rent growth, we have an average function. So we're going to go back to our inputs and assumptions, and we're going to take an average of these rent growths. That's just going to give us our average. Is a pretty simple function. And then moving down to our stabilized vacancy rate. So for vacancy rate, obviously it's going to be pretty high when we buy it, and there's a lease up period, and then it's going to stabilize at some lower percentage. So we're taking a minimum function, so min, and then you're taking the minimum of these vacancy percentages right here. And if that were to change, obviously we want a model to be dynamic, and that'll change, and then it would show up on the investment summary as well. Now, again, I will say that these numbers, if you're going through this, your numbers might be a little different than what they are right for me right now. Don't freak out because we might be shifting some things. And again, this is a model, so it's going to fluidly change, and it should be changing as assumptions differ. Our exit cap rate, again, is just from our inputs and assumptions of C25, and that gives us just our exit cap rate right here. Our purchase price and property summary, it's just J19. It's pretty straightforward. We've got our purchase price there, and then per unit, again, we're dividing it by 012 and then 011 for, or 013 for 11 and 12 for net rentable square footage. And then our acquisition debt is just from our loan sizing and amortization. So we're going to go over to this tab, and I believe it said F3. Yeah, so F3, loan sizing and amortization. We've got just our beginning balance of the loan itself, which is pretty much our minimum loan, which we decided after the 3 tests was our LTV of 30, of 70%. So yeah, that's just pretty much what that is. Again, our loan to value 70%. That's from our loan sizing and amortization, our interest only period. So this is obviously in monthly. In our loan sizing and amortization, it's going to say 12 months. So then we divide that by 12, and then obviously you can put years there in custom formatting. Our adjusted trailing cap rate is in our inputs and assumptions at C11. It's our purchase cap rate. And then our year one operating cap rate is going to take a sum of our first 12 months of operations and then divide it by our purchase price and inputs and assumptions to get that year one. It's pretty much it's year one NOI over cap rate, over purchase price to get your year one cap rate. And then our physical vacancy is 1 minus our physical occupancy. So it's C7 in our inputs and assumptions. So physical occupancy, 88%, and you take 1 minus that and you get 12%. Obviously, number of units, net rentable square footage, and then the vintage. It was constructed in 1985. Now, for our sources and uses, we've got our capital structure here: senior debt, preferred equity, LP equity, and sponsor equity. Now, for this deal, we do not have any preferred equity. So for our senior debt, we have loan sizing and amortization of C16, which is just what we decided was our minimum loan, which is our LTV of 70%. And then for any of these percentages that you're going to see here alongside the numbers, that's just that number over the total equity. So it's just that number over the total, and that's going to be the same for all of these numbers. It's the same here, and it's the same here. Now for our senior debt, obviously I explained our LP equity. This is going to take a sum of a few things on this tab. So it's saying J19, it's saying our purchase price minus our senior debt plus our closing costs and CapEx and reserves. So your LP is going to cover closing costs and it's going to cover your CapEx and reserves. And then you're multiplying it times the waterfall C3, which is the percentage of that limited partner is going to be paying. So you're multiplying it by their percentage, and then you're adding J21, which is your LP, which is your acquisition fee, and they're covering that as well. And then our sponsor equity it's a pretty similar sum function, just pretty much differs in what they cover and what it involves. We've got our initial purchase price minus our senior debt, and then with the closing costs plus CapEx and reserves times our waterfall again C4, which is just the percentage, which is 20%. Then we've got a total to add those up. And again, these numbers are our closing costs. This is a percentage of, in our inputs and assumptions, I believe it's 3.5% times our purchase price, and then acquisition fee. Again, it's a percentage, 0.02. It's hard coded in here. So 2% of our 2% of our purchase price, and then CapEx and reserves is the sum of these interior and exterior reserves, which again we decided was $42,000. So that's an overview of this tab and pretty much all that we'll get into on this video. Again, we're going to be going over the model in person with you guys, and we'd encourage you guys to ask questions and make sure that you get this all down because we do want to build a solid base moving forward. Thanks a lot for taking time to watch this video.